Welcome to the New Warehouse Podcast, the podcast for those that are curious about what's possible inside their four walls. Before we get into this episode, let's hear a word from our sponsors that make this all possible. If you're thinking about voice picking, think EPG, the team behind Lydia Voice, the industry's #1 voice picking solution. Warehouses rely on diverse teams, but language barriers can slow everything down. Lydia Live Translation empowers warehouse staff to communicate naturally in over 40 languages in real time. No template training, no dialect detection headaches. See Lydia Live Translation in action at Modex this April in booth B11122. That's booth B11122, or visit epg.com to learn more. Are you drowning in pre-sales engineering? Struggling with resource allocation? Losing opportunities because it takes too long to respond? Quoting shouldn't take weeks. Every delay slows momentum and puts revenue at risk. Today's automation buyers expect instant answers, clear options, and numbers they trust. iAutomate helps system integrators and solution providers create a customer-centric digital buying journey and deliver data-driven concepts and budgets, instantly accelerating pipeline velocity, increasing win rates, and turning speed into revenue. That's sales automation. Learn more at iautomate.app. That's iautomate.app. Running a 3PL with LPG or diesel forklifts? Fuel volatility, emissions, noise, and downtime add up fast. Big Joe Forklifts offers a smarter path with lithium-ion trucks featuring integrated batteries and onboard charging. No fuel handling, no tank swaps, fewer interruptions. Their Pulse telematics platform gives leaders real-time diagnostics, energy insights, and downtime prevention. You can see it all at Modex in booth 9313. That's booth 9313. And a special bonus, if you say Kevin Lawton sent me, you'll get an exclusive swag package. Check them out, booth 9313. That's Big Joe Forklifts. There's no guessing when it comes to operations. We need the truth. Sergere provides that truth when it comes to your most critical systems and operations. Trusted to bring the truth with 99.9% data accuracy to some of the world's largest companies like Honda, Toyota, DHL, Whirlpool, Cat, Eli Lilly, and more. When you need truth in your warehouse operations, bring in Sergere. Get the truth at sergere.com. That's SURGERE.com. Is your fulfillment operation ready for the next surge in demand? Don't wait until productivity stalls to think about automation. Get proactive and talk to Ocado Intelligent Automation to find out when to start your automation journey, how smart software orchestration accelerates performance, and how AMRs like Chuck scale across sites and seasons. Learn how flexible deployment, ongoing support, and real scalability help you meet your customer expectations before peak hits. Head to OcadoIntelligentAutomation.com to start your warehouse automation journey and find them in booth B10119. That's B10119 at Modex. Thank you to our sponsors, and now let's get to the podcast.
The New Warehouse Podcast, hosted by Kevin Lawton, is your source for insights and ideas from the distribution, transportation, and logistics industry. A new episode every Monday morning brings you the latest from industry experts and thought leaders. And now, here's Kevin.
Hey, it's Kevin with the New Warehouse Podcast, bringing you a new episode today. And in today's episode, I am going to have two guests join me, and we're going to talk a little bit about the industrial real estate market, of course, how it pertains according to warehousing facilities, how the demand on space is changing a little bit, and what's the factors causing that change, and how you should prepare yourself to be able to navigate that if you are looking for space. So I'm going to be joined by Brandon Page, who is the Executive Vice President and Head of Leasing and Customer Solutions at Link Logistics, and Stephanie Rodriguez, who's the National Director of Industrial Services for the U.S. and Executive Managing Director at Colliers. So happy to get you both in here on the show and happy to talk about this topic because I think we see a lot of shifts and changes in the landscape of warehouse and distribution in general. And obviously, real estate is a huge part of that. Can't have a warehouse without a building, right? So let's kick it off here first. Let's get a kind of a brief overview of Link Logistics and Colliers for people that aren't familiar. So maybe Stephanie, you want to kick it off for us and tell us a little bit about Colliers?
Sure, happy to. So Colliers is a global real estate services provider. What does that mean? We advise owners, occupiers, and investors on commercial real estate. So whether that's brokerage services, management services, investing, purchasing land, and then developing it, all of those sorts of things. So we partner with companies like Link all over the US and in some cases around the globe to advise them on their real estate holdings.
Okay. All right. Great. And Brandon, tell us a little bit about Link Logistics.
Yeah, sure. Happy to. Link is a wholly owned portfolio company of Blackstone. Link is the largest U.S. only owner and operator of last mile real estate. Our portfolio is roughly 3,000 buildings, right around 470 million square feet, coast to coast. That works out to be about 7,500 different customers. And sort of claim is that nearly 5% of U.S. GDP runs through our facilities. So it's a meaningful portfolio here in the U.S.
Yeah, absolutely. And I see your buildings as I drive up and down the New Jersey Turnpike here in my home state. So Brandon, tell us a little bit about how you work together with Colliers.
Colliers is definitely one of our most important brokerage relationships and partnerships. We use Colliers agents across the country representing us both on renewal discussions as well as marketing vacant units on our behalf. We obviously work with Colliers tenant rep teams in order to try to advocate for our assets to get tenants in there, work closely with their supply chain group, as well as some of the investment side of the business as well. So really touch a lot of different aspects of Colliers.
Yeah. And what about Stephanie, from your side? How do you view the partnership or relationship?
Brandon put it perfectly. We partner with Link to help them lease their new space that's vacant, to help them work with retaining their tenants in those buildings. We will try to bring them opportunities for investment, whether that's land for development of new projects or purchases of projects and also disposing of them. So our tenant rep brokers also have strong relationships working to bring their clients to Link buildings. So it's very much a collaborative partnership.
All right, great. And happy that we could get you together here to talk about that partnership a little bit, but also collectively talk about what are we seeing in the market. And, I think it's two kind of unique perspectives here. Brandon kind of bringing from the perspective of what are you seeing from the tenants and people that are inside your buildings. There's roughly 7,500 different customers you talked about. And Stephanie, from your perspective of looking not only, as you mentioned there, from the building aspects, but also potential projects that are on the horizon as well. So Brandon, maybe you want to kick this one off here. How would you describe the real estate market currently? We're into 2026 here as we're recording this. So what does the market look like in the beginning of the year right now?
The first word that comes to mind, I think, is balanced.
Okay.
There's some nuances with really every market, and even submarkets within certain markets act differently. But when I speak broadly about the industrial market, I think balance is probably the word that comes to mind. We've got occupancy rates across the country sort of averaging in the 7 to 8% vacant range. Pretty balanced there. Customers have options. Landlords have activity on vacancies, and then to kind of go along with historical average from a retention standpoint sort of makes you feel like we're in balance. I would tell you from a landlord perspective, it doesn't feel great, which sort of suggests that it's certainly not landlord friendly, as landlord friendly as it was maybe here during COVID and sort of the tail end of that. But it's a healthy market that's balanced, that is certainly stronger in some pockets than others, but feels functional in most aspects of business.
Gotcha. And you mentioned the differentiation in pockets there a couple of times. So tell us a little bit, I mean, are you seeing a big difference in one area of the country versus another? Is it another area right now that's like super hot?
Yeah, I mean, I'd say it's a combination of both location and size ranges. So I would say if I'm going to generalize, the Sun Belt is definitely an area that's seeing tremendous growth with tremendous demand. And that's a combination of sort of onshoring, nearshoring, population growth, consumption, sort of all of those benefits that you're seeing. Really, I think they're like Dallas and Atlanta and Phoenix out west. Those are certainly markets that are doing well. I think if you look back on 25, and one of the challenges that we had was really a lack of bulk leasing. And so we could go and I could even look at specific markets and say under 50,000 square feet or under 100,000 square feet, leasing is really robust and feels great. And above 250,000 feet, it's really slow. So it's sort of a tale of two markets. And I think that's one thing that we're looking for here as we kick off. I think it finished stronger in the end of 25 from a bulk leasing standpoint. And Stephanie will have, I'm sure, some national stats that she can share around that I think we find really encouraging. But, you're certainly seeing some of the smaller size spaces and last mile infill, which we're predominantly own in our portfolio, as being fairly resilient here over the last couple of years.
Interesting. Yeah. And very interesting to hear from that perspective. And Stephanie, what are you seeing from your perspective in the market? Because you're seeing both sides, right? Not just from a landlord perspective, but tenant as well, right?
Right. Brandon is spot on with his statement that things are getting to this more balanced space. It was definitely more imbalanced going into 2025, and we did see that vacancy creep up nationally. And this is all on the heels of that unprecedented demand that we saw coming out of the pandemic. So there was such tremendous activity in industrial real estate 2020 into 2023 even, and then a tremendous flurry of construction of new space flooded all of the markets, not just any one in particular, just to feed that demand. And then we saw really a stabilization on that demand front. So that was when that vacancy ticked up rapidly last year. And I think we're pretty much at a peak right now. Very little space is delivering in the market overall as we go into the beginning of 2026. The construction pipeline has dwindled significantly because developers and owners like Link have really paid attention to what's going on in the market and the market fundamentals. So that flood of construction has tapered, and it's giving us a chance to absorb all of that space as we go into this new year. As for the comment on the bulk versus the smaller blocks of space and the activity there, that's also what we see on a national level in all of the markets that we track and are active in. Big box did slow down a bit. So those 250,000 square foot spaces and larger, the activity slowed. And I think a lot of that had to do with the uncertainty in the market. Tenants didn't want to make those big bets. It's a lot easier to take down a smaller space in a market where you've got the demand and the need for it than it is to make a big bet on a 1 million square foot lease in a market where rents were not as low as they once were. So definitely the fundamental, the meat and potatoes, we like to call it, where, those healthy, nice size spaces, but that activity, like Brandon said, infill, last mile, there was still a lot of demand in that space. So we had to do a lot more deals to absorb square footage than just one big 1 million square foot lease in a market.
Very interesting. And you mentioned we're kind of getting to a tipping point, right? And is that tipping point meaning that Brandon's going to be happy because it's going to favor landlords more now because there's less space available? Is that what you mean by that?
I think that obviously the supply demand of economics, it still applies to real estate. When there's a large variety of space and everybody's trying to lease it, what are they doing? They're getting more competitive with rental rates, concessions, things like that sort of impact how an owner investor looks at their real estate holdings. But it's more advantageous for a tenant because it's a more competitive landscape. We saw rent growth slow as we flooded the market with availability. And I think that tipping point is we're going to start as that space gets gobbled up and taken down by tenants, and there's less vacancy in the market. we'll see more rent growth opportunity, especially in those markets where the vacancy is low and the market is already in a balanced state.
I see.
I think it's interesting too when we look at like tenants in the market have remained pretty consistent. I think it comes back to what you're saying, Stephanie, where it's not as if the demand went away, and the frustration for both the brokerage and the ownership side is that they just paused making those decisions. And so I think everybody worked harder last year, had to work twice as hard or more in order to actually get a deal done. But again, it's one thing if the demand isn't there and everyone's sitting around going, oh, what are we going to do? The reality was the demand has remained there. It just hasn't been enough certainty on the customer side to make those big bets. In a 1 million square foot building, that could take 12 months to stand up. And you think about all of the different ups and downs that we face on a daily basis, let alone over the course of 12 months, and the capital expenditures it takes to actually get into one of those facilities. All of those things were just a perfect storm for everyone to just take a step back and pause and say, okay, we're just going to hang out for a little bit and see how that plays out. And I think our fourth quarter was as good as we've had since going back to 2021, which was really positive. And we sort of view that as a catalyst here as we move into 26. The customers have to make decisions. Business is there. They have to make decisions. They can no longer pause some of these things. The availability within their warehouses, the shadow space per se has gone down year over year. And it's an opportunity for them to, at a time where they still have options in the market, to make a decision in a facility that's going to work well for them long term. Too many of those groups make decisions soon. And as Stephanie mentioned, there's shortages in certain size ranges, and that's going to be a problem as groups need to satisfy requirements, and there won't be buildings because of the lack of new supply coming online.
There's an interesting dynamic too with how we've seen the process change for the occupiers of the real estate. It used to be their head of real estate could make those decisions. Now the C-suite's very heavily involved. So we're seeing, like Brandon said, the time that it takes to have these decisions move forward has been lengthened just because they have more layers to get through internally on their end to make those decisions. And that's where folks like my team come into play, just being able to provide them with the data and help match them with landlords like Link, who are really a pleasure to lease from. They build excellent quality buildings that are modern and efficient. Our team works with those occupiers to help facilitate those transactions. But it's definitely like a shifted landscape in the last few years where we've seen they're really evaluating risk on their end, no different than a landlord evaluates the tenant coming in and any risk that they might bring with them.
Interesting. Yeah. That C-suite getting involved, they always want to slow things down, right? What's going on with that?
It never speeds it up.
That's for sure. So very interesting, though, that kind of shift in who's really paying attention to that. And I think a great kind of point there at the end, Stephanie, where you're mentioning that they're assessing the risk just as much as the landlord is assessing them for risk, right? And in that sense, which I think is a very interesting kind of shift there. And I want to take one step back there because I want to define this term, Brandon, that you use, because I haven't heard this before. You mentioned the shadow space. What is the shadow space?
It's really, if you think about a facility and trying to understand how full it is, how they maximized occupancy within a facility. And when I say occupancy, it's really cubic efficiency. So how much of the cube are they utilizing? And so you've got, in some cases, you could walk into a building. It is not clearly defined, but you could walk into a building where they only floor stack and you say, we're 100% full. And then you could walk into a 6-story Amazon facility where they're saying we're only 90% occupied, yet they've got 500 times the amount of products that are in space. So I guess what I'm saying is, if you talk to certain 3PLs, a lot of them will say historically they were in like the 3 to 5% of a facility was either underutilized or was there for, as business swelled or shrank, it was just space that wasn't just always full. And as we went into COVID, the response, and some have heard me say this before, but it was, we're just going to lease it and then we're going to figure it out later. So they leased all this space. We're now several years post-COVID. Their business has grown, but they took too much space to begin with. And so they went from having too much square footage within their total network. And we're seeing that shrink to the point now where if you have only 1 to 2% capacity within your network as a 3PL, really challenging to grow your business. It means you're really then forced to go out and look at new space. And as we look at some of the new up and coming occupiers, or those that are more active towards the second half of last year, first half of this year, 3PL is right at the top. And I think you can directly attribute the amount of space they have available within their current network to accommodate either expanding customers or take on new clients altogether.
Interesting. Yeah. Yeah. I hadn't heard that term before, but it makes total sense. So I've been responsible for calculating space utilization in an operation before in my career in the past. And that was very interesting as you said, the definition around space utilized can vary from operation to operation. So interesting there. So now you mentioned, Stephanie, that the C-suite is getting more involved in these real estate decisions now, right? Which I imagine not only with kind of the evolution of what operations are doing, not only from just a business model standpoint, but also from a technology aspect as well. And now the C-suite, I'm sure, has different things that they're looking at too than just the traditional head of real estate might look at as well. So what are you seeing are some of the kind of top drivers for demand in the kind of warehouse distribution specific buildings currently?
Are you looking for more of the holistic, like technology, geography, power, that sort of thing, or?
Yeah, I think everything. I mean, what really is like important to these companies at this point?
I mean, we're hearing it used to be very strictly location. Location was the most important thing. And then labor was right up there with location. Now, power, and Brandon can probably echo my comments here, and he may have a different perspective, but power availability is huge. And can they have redundant power? Just so for future planning, because warehouse tenants tend to be fairly sticky. They tend to move into a space, and unless it's completely dysfunctional for them, they'll stay for a long period of time. So they're really future-proofing their occupancy more than anything. So making sure that they have adequate power, it's one of the most critical factors in their planning process. They're still concerned with labor, but a lot of that comes more with the really heavy occupiers and even the manufacturing component, which we haven't even touched on since we're a little more focused on the distribution in the conversation today. But those are all things that are really at the top of their list now.
Interesting. And it's interesting to hear the increased kind of demand and need for that energy and the power as you're talking about, which I think makes sense because we see certainly an influx of more technology and more things that require that power, especially like on an automation front where we're running tons of conveyor, a bunch of forklifts, robots, ASRS systems, all of those different things. So Brandon, on your side, how, from like a landlord perspective, how are you looking at that demand and making sure that your buildings can kind of meet some of those things?
Yeah, at first, I totally agree with what Stephanie said. And I think from the landlord side, as we were fielding inquiries from customers, it was always transportation, one, availability of labor, two, and oh, by the way, rent, three. And power availability is probably number one or number two, if not 1A or 1B along those. So that's something that even a couple of years ago really wasn't even a consideration. I'd say we've gone through and done a full audit of our entire portfolio and tried to understand where do we have excess capacity within existing buildings, where do we have capacity within jurisdictions around, we might be able to, is there a higher and better use for what was once just a warehouse building to take it to maybe a powered shell or something along those lines as we look at some of these massive power requirements for different data centers and AI needs. And it's certainly a dynamic that's shifted. I think we started with the electrification of fleets, solar, all these different new requirements that, and all of a sudden AI comes in and just completely dominates the conversation from a power requirement standpoint. But it's very much top of mind and something that certainly from an acquisition standpoint, we're very mindful and looking at this really as right off the bat in terms of whether it be a land site that we're looking to buy and develop, or if we're buying an asset, trying to get a better understanding of existing capacity of power and then availability to add to it is very much top of mind when, like I said, maybe a couple of years ago, it really wasn't even a consideration.
Yeah, very interesting. And interesting to hear I could definitely imagine coming into this conversation, obviously, that power and energy were certainly like top concerns, right? Especially with all the technology that we talked about coming into these operations. But to hear that it's moved to almost the top of the list in terms of demands, I mean, it really highlights like the importance of that. So I'm curious, we have certainly tons and tons of old buildings, right, in the country. I know there's tons where I am in New Jersey for sure, and new buildings as well. And assuming that the majority of a lot of those new buildings can handle some of this kind of shift in demand and are being built to specifically handle some of these demands as well, as you mentioned there, Brandon, when you're looking at new sites. But how is that impacting like demand for older existing facilities that maybe have been around for many years and not have been as updated?
Yeah, I think I mentioned it before, but I think customers are always looking at a way to maximize that cubic efficiency. And I think they're constantly evaluating how they can deliver their products faster, more efficiently, ultimately cheaper. Does that mean a state-of-the-art facility? Does that mean being in a irreplaceable last mile location? I think obviously the best case scenario is to have a brand new building in an irreplaceable infill location. That's not always the case. I think one of the theses as we've been building up this company since 2017 was to own the best infill, last mile, best location. It's certainly reflected in our development portfolio. We've got roughly 3 million square feet under development today. All of these are super infill sites, planned to be going spec with them. They're multi-tenant. They are state of the art, but that's not always the case. And I think that kind of comes down to what do you benefit the most from? Is it the proximity and speed to market? And I think the answer is different depending on the use, but certainly for last mile, speed is critical. The location largely overcomes maybe a perfect functional facility that's just maybe not in the perfect location. So the old location still rings true in most cases.
It's interesting if you look at the statistics of modern big box or bulk space and what leased last year, roughly 70% of the demand in the market in 2025 was for the more modern big box industrial space. Vacancy rates, however, also climbed higher in that sector nationally. So I always say there's a shoe for every foot. And some folks don't need that modern facility. And they are, like Brandon said, for whatever, even if it's an older building, but it's infill and it's closer to their customers, that may be better for them. It just really depends on what the need is for the occupier. So despite the fact that we may be still working in markets where there are older, less functionally efficient spaces, there's still something for everyone out there. And I think that holds true. Even though the national average in vacancy is higher than it has been for the last few years, people are still leasing both kinds of space.
Yeah, and I'm curious, if I'm a warehouse operator and I'm looking for a new space, is there opportunity to get like a better deal on an older space because maybe it's not upgraded and then I can invest in that infrastructure upgrade? Or am I better off to go with a newer space if I need some of those requirements? So it's what's like some of the trade-offs to weigh there?
From my perspective, I think it really depends on what your needs are. What are your primary drivers and what your business model is? If you want to be closer to your consumer, then perhaps that infill, like Brandon said, location is the key driver there. If it's somebody who's looking for a large distribution facility with a lot of dock doors, then perhaps a large cross-dock building is a better option for you. So I think it really just depends on the use of the space specifically. And some of our larger sophisticated tenants that we work with around the country, they have both buildings in their portfolios. It just really depends on their business model and how their distribution network is designed and how it suits their needs the best.
Yeah, I agree. I think it's interesting too, is even within, let's just use a certain retailer that may have a business line that proximity to customers most important. They can pay more rent in a certain location, and they may have, let's call it like a returns part of their business that is much more cost sensitive, that cannot really operate within the same metrics that you could. So even within the same, I spent a lot of my time with the larger occupiers in our industry, and you have different requirements within those same organizations. So definitely one size does not fit all. I think the groups that are generally willing to pay more, and I think what I love about industrial, it's super basic supply and demand. It's Econ 101. I want to own the building that's in the location that the most people want, so that I have the most interest and can, in theory, obtain a higher rent for an asset that people want. The more physical attributes that you take that are less desirable you just take less people that could be interested in that, which means ultimately the rent has to go down to compensate for that. So I agree. I think there's a shoe for every foot. I do think there's assets that are ultra functional, poorly located, and all the way in between that make perfect sense, even within the same customer, based on different needs that they have and the requirements that they have within different aspects of their business. So it is what makes industrial fun. It's a very diverse and bifurcated group of customers that utilize our space.
Yeah, absolutely. And Brandon, you mentioned that Link has been working on building this business since 2017, right? So about nine years or so, right? So I'm curious, from that time in 2017, obviously we had a huge catalyst, which did a lot of shift in the market, which was the pandemic. But is there anything that back then that in the market people weren't even really looking for that now has become like a must-have in the building that's surprising a little bit?
It's a good question. Boy, I don't know, Steph, you've got a good one to answer that. I don't know if it's changed a whole lot, to be honest with you. I do think a highly efficient supply chain network can effectively make the rent go away in certain buildings. So there are groups that seem to be more rent sensitive. I don't think, if I step back in 2017, did I think rents were going to double or triple in some markets in a 2 to 3 year period? And absolutely not. I think if we did, we would have bought more than the 500 million feet that we bought. It's hard to believe we could have bought more than we did in that period, but nobody saw that coming. But I do think just the importance and the tailwinds that we have from e-commerce and the constant push to try to deliver products faster. We started years ago with Amazon. It was within a week, and then it was within 2 days, and then it's 1 day, then it's same day, and now we're testing out 30 minutes in some locations. We've got drones going and doing deliveries. So this push and this constant urge to get products quicker and more efficient, cost effective. Clearly, the numbers support faster delivery equals higher sales. Amazon's led that. There's a lot of retailers that are following, and some are catching up in some regards. So I don't think there's a physical attribute to the building that's completely changed, but I do think the importance of well-located assets relative to their overall network and that surge to try to get faster has become more important than maybe it did when everybody was willing to accept something showing up in a 4 days, 7 days, 8 days, whatever the case may be. I don't think that's accepted. It's certainly my
7 days, 8 days, unbelievable. That would be ridiculous at this point.
Even 2 can be frustrating.
I know, right?
But so much for Prime. No, I agree with Brandon's comments. I will say that we have seen an evolution. I've been focused on industrial real estate for a bulk of my career, and I've been in commercial real estate for 27 years. And I've seen more recently, it's not a must, but if they can get it, they like it. And that is the labor market is very competitive, especially in some of these locations where we see when you're flying into an airport and you just see bulk building after bulk building, they are all fighting for the same workers in those parks or in those submarkets. And so how do you provide an edge to keep your labor in place and happy? And some of that is on-site amenities. So we're seeing some of the more sophisticated occupiers in the last 10, 12 years have been putting a little bit of focus on creating leisure space and things like that in their facilities so that they can keep them captive and happy and give them an appropriate break in their shift, but offer a little something that maybe the neighbor down the street doesn't have. I think that's what stands out in my mind. But otherwise, it's really just they're looking for those power capacity so that they can upgrade and modernize and adopt technology in the space so that it can even become more efficient for them.
Interesting. Yeah. An interesting point there about the leisure space. Because I mean, back when I was managing facilities, and I'm sure you all are familiar with the Cranberry, Dayton, Jamesburg area of New Jersey, right? I think Link's got a couple buildings around there, Brandon, I've seen, and super competitive trying to get people, especially during pandemic. I was managing a building during the pandemic. And I'm curious on that note, Stephanie, what is kind of maybe some of the most interesting leisure space you've seen? I think that would be very insightful for some of our listeners on how they can help create better retention.
I mean, it's not even that crazy. It's just a large on-site break room. Sometimes they bring the food in, so they cater on-site, ping pong tables, pool tables, just a variety of sort of ways to blow off steam in a space. We even see it in office buildings now, in
Sure.
office
Yeah.
spaces, golf simulators, you name it, they can imagine it, just as a way to give their employees that sense of we care about
Mhm.
you and are trying to create a community here. So those are some of the more common things that you see when you're touring some of these facilities.
Interesting. Yeah. Yeah. And I love that. I think that's great because it's hard to compete sometimes if you're got an Amazon down the street from you that's going to offer $4 or $5 an hour more than you can. Right.
That's right.
So really interesting there. Now, Brandon, you mentioned a little earlier about solar panels and electrification of fleets that are driving some of that stuff. But what is the view from some tenants and things in terms of demand around kind of sustainability initiatives and looking at, do they look for solar powered buildings? Do they look for other sustainability kind of things? What are you seeing?
I think if we're being honest, it comes up a lot less today than it did in the past.
Okay.
I think there's certainly corporations that have very clearly stated public goals, and we certainly partner to help those groups achieve those goals. There's definitely a cost associated with sustainability. And I think back to all of our buildings are clearly LEED certified, and we're doing all the things that we can do to be a good global partner in that regard. The reality is margin pressures that I mentioned earlier are coming into play. And, and there's a cost, as I mentioned, to having some of these sustainability aspects. Yeah. And so those that are willing to pay for it, we're certainly partnering with it. We'll try to be creative. We'll do all the things that a good partner and landlord would do. But I would say when you're getting hit on all these different sides on the cost piece, an extra 5 to 10% generally gets turned down, and has more recently than it had been maybe over the prior couple of years as groups plowed forward with some of those corporate initiatives.
Yeah. And what do you see on your side, Stephanie?
We're seeing the same thing. It comes up a lot less than it did, say, 10, 15 years ago when it was the newer thing. When we do talk about it, it's more about fleet charging. Okay. It may be some solar installations, and it's really more to mitigate risk when it comes to their operations. So if there's a power outage due to a natural issue like a hurricane, how can we continue to operate our business? So it's really more of risk mitigation than it is a sustainability initiative. We're not seeing that as much. They like to know that they're in a LEED certified building. I think a lot of our more sophisticated tenants that we work with, but in general, it has not been something that we're hearing a lot of talk about when it comes to assessing what their real needs and wants are in a space.
Interesting. Yeah. Yeah. And interesting to hear that shift a little bit. And I think that makes sense with things going on. And, really interesting to hear from you both on what's going on in the market and how things have shifted over time, and really interesting to hear about the demand aspects and how that's shifted as well. I think that tells you a lot about the market and what's happening inside those operations now and what people are looking at and what they're trying to achieve with their businesses. So as we close out the conversation here, I'll ask you both one more question here. If we look towards the next year, maybe 2027 as well, in real estate, what would be your kind of top piece of advice for people that may be looking for space or thinking about expanding their network? And maybe Stephanie, you want to take that one first?
Sure. I mean, not to make it sound like a sales pitch, but I say always work with a good real estate advisor. That's really critical. Occupiers of real estate is not their business. So I think when you can partner with somebody who can advise you and help you navigate the landscape, which can be very competitive, it's always a bonus. It allows you to continue to operate the business, and it allows somebody else to do the searching and the vetting of your potential home in the future. And by home, I mean warehouse, not residential real estate. Yeah. I mean, we spend a lot of waking hours there, right? Yeah. So that's always my advice, is to work with somebody who knows the market, understands the landscape, and can really advise you as you move forward in that decision-making process.
Yeah. And I think that's a great advice too, because the average person, right, is not going out and getting a warehouse or a warehome every single day, right? So going to a trusted advisor and expert is the way to go for sure. And Brandon, what would be your advice for anybody that maybe is looking for space in the next year or so?
Well, I feel like I have to say you should go with a reputable institutional owner that's well capitalized along with your.
Do you know
I
it?
totally agree with
it?
I don't know one. Look, I think if you really step back, we've got really great secular tailwinds. Number one, e-commerce continues. We talked a little bit about onshoring and nearshoring, and then we've got this data center demand. And as I think about what's going to evolve over the next couple of years, I don't think we've even scratched the surface on how AI is going to impact our business. That's going to be from how groups decide where they are going to have locations. We have a lot of data that is one of our clear differentiators as being part of the Blackstone family. We're going to be leveraging AI. We are leveraging AI to help us try to spot demand, where it's coming from, where we should be buying buildings. And I spent a lot of my time kind of thinking about where's the ball going next. And I think these are the kinds of data that's going to help us help own buildings in the locations that our customers want to be in. And that's really what it's about for us is doing that. So I think it's going to be, there's a lot of change that's going to happen in the world over the next couple of years. And I feel like industrial is really well positioned to take advantage of a lot of those shifts and changes, and as well as the great secular tailwinds we have behind us.
Yeah, absolutely. And I think that's great to have the data to really understand that and be able to anticipate that demand and make sure that there is space where space is needed. I think that's great for all, from both sides of the table, right? So great to hear from you both and learn about kind of what's happening in the market and maybe what might be happening in the future as well. If people are looking for that trusted advisor, Stephanie, what's the best way to learn more about Colliers or get in touch?
Well, of course, our website, colliers.com, and you can search for experts in each of the different markets that we operate in, or you can find me on LinkedIn and also on the Colliers website. So feel free to reach out if I can be of service in any way.
All right, great. And if people need an amazing building, Brandon, what's the best way to learn more about Link?
Sure. Linklogistics.com. I'm on the website as well, Brandon Page, or in LinkedIn. We have 75 leasing professionals that represent our portfolio across all the major markets across the U.S. So feel free to reach out to me, and I'm happy to put you in touch with one of our local experts as well.
All right, fantastic. And we will definitely put all that information at thenewwarehouse.com as well as in the show notes here so people can easily find it. So Stephanie and Brandon, thank you so much for joining me on the show today.
Thank you for having me.
Yep. Thank you very much. Appreciate it.
You've been listening to the New Warehouse Podcast with Kevin Lawton. Subscribe and check us out online at thenewwarehouse.com.
Enjoyed this episode? Make sure you are subscribed to the podcast, and for more content from the New Warehouse, find us on LinkedIn and YouTube. Links to subscribe can be found in the show notes, and for everything The New Warehouse, head to thenewwarehouse.com.